right, so for the past I don't know how many weeks, but we've been tackling candlesticks basically, and we've completed all the candlestick patterns. So we are moving on to market structure. Okay, so when we talk about market structure is basically price action. Okay, so market structure goes with candlestick patterns. So it's the candlesticks that form the market structure. Okay, so okay, so let's go into it. Okay, so we're here. All right, market structure. So one of the most important skill that you need as a trader is the ability to read the market structure. Okay, so market structure is also basically is the way price moves on the charts. Okay, so it helps you to identify the trends. It helps you to identify reversals. When we say reversals, I mean, it explains itself. If market is going up and it reverses, so when it reverses, then it starts going down, right? Yeah, and also helps you to spot areas of interest where you might want to take a trade. Okay, so you can think of market structure as a skeleton of price action. Okay, so let's read over the books here. So you're not going to trade all the markets the same way. You need to study how the markets move. So yeah, every market, so like forex, stocks, and even some of the forex markets itself, like maybe gold and USD or GBP against the US dollar, they all move in a particular way. So think of them as humans. Okay, so let's say the gold chart, gold against the US dollar. There's a certain way gold moves. Okay, so the more you trade gold, or the more you trade the gold markets, you'd get familiar. The more you get familiar with the way it moves, the way it behaves, its attitude. Okay, and for maybe GBP USD, which is the Great British Pound against the US dollar, also has a particular way it moves. It has its own attitude, behavior. So every currency pair, every market has a particular way they move, but it's all called market structure. Okay, but it's just slightly different for across all of them. And the difference is not even much. It's just the way they work and how they respect certain things. So we'll go into it briefly, but it says if you master the skill, when you open your chart, you'll be able to answer these questions. So what are the crowds doing? So basically, who is in control of the markets? Is it the buyers or the sellers? What is the right time and place to enter or take the trade? And through your price action analysis, you will experience three types of markets: trending, ranging, and choppy. So we have three types of markets. That's all it's saying. We have a trending market. So when we say a trending market, just think of a stairs. Okay, so the stairs, we have a market that's going up, so stairs going up, and then we have a market that's going down, so it's trending down. So we have an uptrend for a market that's going up, and then a downtrend for a market that's going down. And from previous videos, I've explained that when the market is going up, it means the buyers are in charge, or it means there's higher demand. Okay, so when there's so much buying pressure, when so many people are buying, the price goes up. Okay, but the price doesn't go up in a straight line. It moves in waves. Okay, so it goes up, comes down a bit, goes up, comes down a bit. That's how the market moves. Okay, just like in what do you even call that thing? I think energy. I think the way energy moves. So when you're picking signals, signals don't just move in a straight line. They move in waves. So they create amplitudes, right? If you've done physics, you should probably know this thing too. But yeah, that's how the market moves, in waves. So we have uptrend and downtrend for trending markets. Okay. So let's go into the uptrend. So with an uptrend, markets is creating higher highs and higher lows. Okay, so what is a high high? A high high is a high that's higher than the previous high, basically. So when you look at this particular structure here, what you can see is the market was going up. Okay, it was trending up. It came down here, went up, came down, went up, came down. Okay, so it was going up, moving in waves, like I said. And with this movement, it was creating higher highs that you have here. So higher highs at the top and then higher lows. So basically every high and every low is higher than the previous one. So here this high here is higher than this previous high. So this was the high and this is a higher high, okay? And then this is the low that I created. And then after this low, price went up, created this high, and then it came down, created this high low, and it went up, created this high. Okay, so that's it for an uptrend. So in an uptrend, market creates high highs and high lows, and when the market is trending up, it respects the higher lows, especially it respects the structure. Do you understand? So if what can I even use as an example? Let's say human beings, for example. Yeah. Okay. When people are walking, they don't walk with they don't do right, left, left. It's right, left, right, left. I think it makes sense. So same thing with the market. It doesn't, if it's trending up, sometimes it's supposed to respect the structure. It's supposed to respect higher highs and higher lows, creating higher highs and creating higher lows. So when it creates a high high, it doesn't go all the way down or like smash the previous lows. When I say smash the previous low, it doesn't go below the previous low. Or when the new low forms and creates a high high, it doesn't come all the way down to it doesn't go below the previous low. Okay, so that's how we can identify the market as an uptrend or as a bullish market. Okay, and then the opposite is for the downtrend. So let's read what the book says. So in here, the market is making use of high highs and high lows, which indicates that the market is uptrending. You don't need indicators to decide blah blah blah. So yeah, visually you can just tell what's happening here. It's creating high highs, high lows. And then we go to the downtrend. So the downtrend is the opposite. So in a downtrend, you can see that the candlesticks are going down. Okay. Yeah. So with the downtrend, markets creates lower lows and lower highs. So lower low, lower high. So it means that every low created should be lower than the previous low, and every high should be lower than the previous high. So it's just the opposite of this. Okay. So we have here this lower high, and the markets came all the way down, created a lower low, then went up, created a lower high, came down, created a lower low, and then okay, so it kept going down, created another lower low here, then went up, created a lower high, lower low, lower high, lower low, lower high. So you can see that the lower highs or the highs here were being respected because it's a downtrend. So when you go into the markets and you see that the lower highs are being respected and then the lower lows are being smashed, or price or the market, basically price keeps going below the previous lows, it means that we're in a downtrend. Okay, but when you go and you see that the market is creating higher highs or is smashing the previous high and respecting the lows, then it means that the market is in an uptrend. And now why this is very important is that when you are trading, you always need to follow this. You need to know the trend. You need to know who is in charge or who has control of the market. Because if you trade against the person in control, you end up losing money. I was using this example some time ago with surfers. When surfers are going to surf, they wait for the wave, right? They don't surf against the wave. So they wait for the wave to form and then they jump right in. Okay, so they surf with the wave or they move with the wave. Okay, and then that's what helps them. I think in swimming too, if you are swimming some parts of the sea or like maybe any water body and like the current is a bit too high, it's best to swim. If you swim against the tide, you'd rather stress, you'd lose more, use more energy and all of that. But when you are swimming with the tide or like with the wave, you expend less energy. Okay, so it's the same thing in forex here. Always know who is in charge and then follow. Okay, so if it's an uptrend, it means both the buyers are in charge. So if you take a buy, you're already halfway. I mean, the odds are already in your favor to smash TP or to take profits or whatever you call it. Okay, but if the market is bullish or if it's trending up like this and you decide to sell, okay, it's good. You can sell, all right, but it's not a good environment to sell because it can be risky. Buyers are overall in control of the market. So if you sell against them, I mean, it could be dicey for you, but it's just safe to follow the trend. But I mean, obviously, people trade against the trend. So some people can trade, I mean, some people can sell here if they know why or when this sell is going to happen. So some people can sell here. Okay. Now, two things we need to know about trending markets. So trending markets create impulsive moves and then retracements. Now we call the so if the market is trending up, so every buy move or every move to the upside is an impulsive move. It means obviously the buyers are already in charge. So when the price is going up, it's moving fast, it's moving strong, it's moving with direction and intention. Okay, so the characteristics of the impulsive move could be you could usually see like long candles like this. So you see long bullish candles, you could see little or no pullbacks. So when I say pullbacks, it's like, when it's going up, then it comes down a bit. So yeah, something like this is a pullback. You can see a lot of candles to the upside like this, and then some little pullback here. And then you have what the book marked as the retracements. So with an impulsive move, it's showing that the buyers are in charge. Okay, so impulsive moves show the strength of the buyers. If it's an uptrend or if it's a downtrend, it shows the strength of the sellers. Okay, and impulsive moves always lead to a high being created or a lower low. So when we come back here, you can see that this impulsive move caused price to create a high. This impulsive move here caused price to create another high. So this higher than the previous high. And then when you go into the downtrend, same thing. The impulsive move here caused price to create a lower low, lower than this low. And then this impulsive move, so you can see the long candles here creating or causing price to create another lower low, lower than the previous low. Okay, so yeah, so impulsive moves are like runners. Okay, so when they are sprinting in one direction, it shows that like they are moving with strength and with some sort of momentum. Now the opposite of so when we have so we have an impulsive move and then we have the retracements. So the retracement is what we call the pullback, or some call it corrections. So what I was saying, price doesn't just go up. So if it's an uptrend, obviously it means buyers are in control, but it doesn't mean that it doesn't mean that the candlesticks will continue going up in a straight line. At some point in time in the market, the price would, basically the price would drop a bit and then continue going up, drop a bit, continue going up. So I think even when the dollar and the CD relationship, I don't know when the dollar started rising, but I think when the dollar started rising, it got to a point where sometimes it would go to like, when it started fresh, I think it was like 8, then maybe got to like 8 CDs and then dropped to like 7 CDs 50 pesos, then went all the way to like maybe 10, then drops again to like 9 CDs 60 pesos, then goes all the way to like 12, then drops a bit, then keeps going up. So you understand? So that's what it does. It moves with impulse and then corrects, moves with impulse, corrects, or moves with impulse and then retraces. So characteristics of the retracement moves, usually see shorter candles, or sometimes you see slow movements in price. So yes, that's why most people like to trade with the trend. You see, retracement moves are against the trend. So if it's an uptrend like this, there's an impulse, it's moving uptrend, so it's going up. But the retracement means it's coming down or it's correcting, it's pulling back. Usually moves like this, you not see so much candlesticks. I mean, it's a bit, sometimes you see the price moving slowly, choppy. Do you understand? It's not motivating to take a trade. Okay, so it's like how retracements even work is, when market is moving with impulse, let's take like it's moving with impulse, right? So at a point it gets tired and it needs to, or like even when you watch the F1, okay, Formula One, it gets to a point they have to I think I don't know what they call that thing where they stop, what do you call it? Pit stop. Yeah, I think it's pit stop. So at the pit stop, they change their tires, blah blah blah, their screws, blah blah. So yeah, it's like that. So I mean, you move with impulse, and then at some point you just chill, and then re-energize, and then move with impulse again. So that's what happens. Okay. Yeah. So usually after a retracement, then the impulsive move happens. And this works for both uptrends and downtrends. So you can see the same thing happening here. Impulsive move, retracements. Impulsive move, retracements. Okay. Yeah. So the next thing to look at is break of structure. Okay, so let's go into the charts. So I was going to use this to explain, but I'll just use I'll just use to explain the break of structure. So we have something we call break of structure. Okay, so break of structure is basically where price breaks the previous high or the previous low. So okay, so let's look at two things here. Now we have something we call swing high and swing low. So although this is a this is a high low, high low, high high, they are swing points. Okay, so swing points, it means that the markets moved from here and then went all the way to this high. So this was the impulsive move, and then it retraced. Okay, and then impulsive move, retracements, impulsive move, retracements, impulsive move, retracements. So these are like, we call them swing structures. Some say swing low and swing high instead of high and high low. Okay, so the swing high was always the peak before the retracement happens or before the down move. So that's what we call the swing high. Okay, and then for a swing low is always the dip before the impulsive move comes in. Do you understand? So, like I was saying, so let's go back to break of structure. And then, so we have break of structure, and then we have something we call change chalk, so change of character. Character. All right. So, with break of structure, what happens here is that when price is at this swing low and then it moves with impulse to this swing high, then for some reason maybe it's tired, so it starts to retrace or starts to pull back a bit. Now at this pullback, I mean after the pull, I mean at this point it's gotten some sort of energy, now it's ready to continue its course or run its race. Then it goes on, moves with impulse, and now takes out the previous high. This here we call it a break of structure. Okay, so break of structure occurs when the previous high has been broken. That's if it's an uptrend. I think let me widen this a bit. So this is a break of structure. So when price breaks the previous high, if it's an uptrend, then we call it a break of structure. So you have another break of structure here. Another break of structure would be here. Why? Because from this swing high, it retraced, and then it created a swing low. Why we know this is a swing low? Because this caused the impulsive move. Okay, so this move here caused the impulsive move. That's why this is a swing low, and it moved all the way to this high. And at this high, this was the peak, or this was the highest point price reached before retracing. Now after the retracement, it got to some level, and then it was, I mean, it got enough energy to continue moving with impulse. So it continued going up. And what happened? It broke the previous high. It broke structure. So break of structure. Okay. Same thing. Same thing happens here again. Swing low, swing high. then retraces, swing low, and then break structure here. So we can even put this here, break of structure. Okay, same thing for the same thing with the downtrend. Okay, let me spread. Yeah, so with the downtrend, when price, we say that price creates lower highs, as you can see here, and lower lows. Now same thing happening here. Okay, let me leave this here and just copy. Okay, so with the downtrend, price would create a swing high and then move with impulse to the downside. So let me use which arrow can I use? Okay, so moves with impulse. So it moves with impulse to the downside. So this is an impulsive move, and then we have a retracement. Usually, the retracement is not that much; it's just like a small pullback. And then what happens? It creates a swing high again, and then moves with impulse to the downside. So when it creates its, this is the retracement. So when the retracement is done and price is moving, it's continuing its downtrend, it's continuing to go down, then what happens is that it breaks the previous low. So once it breaks the previous low, then we know, okay, price has broken structure. It means that we are still in a downtrend. But if for some reason, it's going down, so ideally for a downtrend, or the characteristics of a downtrend is price would keep breaking, or should keep breaking, the lower lows. So if for some reason price is going down, it's going down, and then at some point here, price is not able to break this low, so it's not able to go below it, and it comes somewhere here, and then what happens after is this. Now this thing here means that now price is not able to close, or is not able to, basically it's not able to go below the previous low. One, that has invalidated what we call a downtrend. Secondly, it has crossed the lower high. It has invalidated the downtrend again, so 2 times. And then what we call that is change of character. So basically, when the market is changing character, it's moving from a downtrend to an uptrend. So when so usually in a downtrend, before you get a change of character, price would have to break the lower high. Okay, so let me draw that clearly. So we have a downtrend, price creates a high, a low, up, then a lower low, lower high, lower low, lower high, and now it can't close below this low, so it comes here a bit, and before you see, it starts going up, breaks the previous lower high. So that's what we call a change of character. So here we would identify this as a change of character. So when price breaks the previous high, or this particular high here, then we call it a change of character. Then usually what you see is the shift from a downtrend to an uptrend. Let me spread this a bit. Okay. Then, so everybody in trading, I mean, the terms vary, but break of structure, change of character, they are terms that are like widely used. Yeah, I think some also call it market shift. Yeah, so market shift, change of character, you get, they're all the same. So break of structure is when price is breaking structure and respecting the characteristics of its trend. So you can see for an uptrend here, okay, this change character. So that's for change of character. So the change of character happened here. All right. So I was saying for the break of structure, price is always it's still respecting the characteristics. Okay, respecting the characteristics, respecting these characteristics. It's breaking the high. It's breaking the previous high and then creating a new high. Retrace a bit, break, and then when it's moving with impulse, it breaks the previous high and then creates a new high. So let's go into the chart and then see how this works. Or try and identify the structure, try to mark the swing high and swing low. So this is very important in trading. In case market structure is the basis for almost every analysis, okay, because you need, when you're getting the chart, you need to know who is in charge before you start even looking at the candlesticks. You see, the candlesticks tell you, I mean, the information the candlesticks give is like is in detail, but you need to look at the, like, on the broader perspective, or look at like from a wider view to know what's really happening. You get, because you can't just go into the market and because you see a bullish engulfing, so you just take a buy. Now you need to go back and see who is really in charge of the market. Even if there's a bullish engulfing, I mean, it's normal for price to create bullish engulfing, right? So it can happen anywhere, anytime. So let's look at, okay, I think we can look at this. So when did this structure happen? Okay, this is a beautiful structure. It's a beautiful structure. Okay. So what do we see here? So you can see that price. So from this level, price was going up. You can see that. And then it retraced a bit and then went up again. Okay, so you can see that maybe here we had an uptrend. Now this is a retracement and then an uptrend, or an impulsive move, breaking the previous high. Let me zoom in. So here, this is an uptrend. Okay, so it came up, impulsive move. So I said impulsive moves are usually characterized by the market is causing me to just keep going back. Okay, so let's start from here. So there's an impulsive move. You can see impulsive moves are characterized by usually long candlesticks. Okay, so you can see long candlesticks over here, then a small retracement or some sort of like consolidation. Then we keep going up, keep going up, keep going up. Then some small retracements, keep going up. Then a small retracements. Then we keep going up. Now, at this point, what happens? Here, price starts to retrace, but we've not even started marking structure. But let's say it retraces, and then what happens is we keep going up. So impulsive move again, and then we have a retracement here, impulsive move. And then at this level, we have something we call the change of character, because it retraced here, and then this low created a new high. So I would mark all this thing, but I just want to briefly go over this before. So retraced and then went up, broke this previous high, creating a new high. So there's an uptrend, okay, respecting the properties of an uptrend until this sell happened. Okay, so price came down, it broke, or it took out the previous low, which means there's a change of character. Now the market has shifted from a bullish or an uptrend to a downtrend. Now, how long did the downtrend didn't even last that long? So here with the downtrend, I mean, lower high created a lower low here, then lower high, then lower low here, then a lower high, then a lower low. Okay, now you see that this lower low here was respected. Price, when it retraced, it couldn't come and break the lower low. Since it's a downtrend, it couldn't break the lower low. So that's one sign or one indication that the markets could possibly be shifting from bearish to bullish. So after this happens here, now you see that price comes up, breaks the previous high, change of character, keeps breaking the previous highs, keeps breaking the previous highs. Now you can clearly identify and tell that, okay, the market has shifted from bearish to bullish. And then before you see impulsive move, retracement, impulsive move, retracement, impulsive move. And now this is a change of character. So now the market starts, you see, changes character here. So now you can see some sort of downtrend. So let's just consider all this area as an impulsive move, and then a retracement, and an impulsive move, and then a retracement. So when you look at the chart, you can see so many waves, but it's not every pullback and every retracement that you need to mark. Okay, but we'll go into that later. So this is just like the intro. So let's just mark out swing highs and swing lows, and then maybe in the next session we can go deeper into how you can identify what would be your exact retracements, or what could what you can identify as a valid retracement or as a valid pullback. Let me use the circle. Okay, so I like to use the circle to mark my structure whenever I go on the chart. So I zoom out. So the first thing I do is I always zoom out, look at who is in charge or where I can start marking my structure from. So if I decide to mark from here, then I'll mark this area as my swing low. So I mark this area as my swing. Let me change this. So I mark this area as my swing low, and then probably this area will be my swing high. So in other words, we can just call this the higher high, and then the higher low. Okay, and then what happens is when price comes down, it goes up and it breaks structure here. So at this higher high was broken here, and then we have what we call the BOS, break of structure. And then what happens, it keeps going up, and at this level it creates a new high. Okay, so I would mark here as my next high, and then draw my circle there as well. So we are still trending up. Okay, and now, so this is the impulsive move. Okay, this is the impulsive move. And then, so even in impulsive moves, if price doesn't even just go in a straight line like that, I mean, you wouldn't see maybe 4 or 5 candles together. It's not, it doesn't happen often, unless like the bulls or the bears are heavy in the market. Unless the bulls or the bears are heavily in charge or have some strong momentum. But you see, this is an impulsive move, so you'd even see some small retracements, little pullbacks. But that's what I'm saying. It's not every pullback or every retracement you mark. Okay, when we say swing high, swing low, we are looking at a dip that caused the impulsive move. Or when you're talking about the swing high, that's for an uptrend. You're looking at the peak where the retracement started. Okay, so just continue. So swing, let's call this a swing high, and then creates a swing low here. So a high low, and then we get a break of structure here. So it broke structure here, and then what happened? Impulsive move to the upside. I don't even regard this as a, so let's just say impulsive move to the upside and came all the way here. So created this high, and then mark this here. So swing high, and what do we have? So this is still as higher low, and this is a higher high. So this is our swing structure. So the area between, or the zone, or this, yes, basically the range between your higher low and your higher high is like your swing structure. That's what we call a swing structure. So if I draw a line here, it should mark. So this is my swing structure, this whole area. So at this level, I should be looking for buys, because why? The market is trending up. But you know, trading is a game of probability. Sometimes you win, sometimes you lose. But you don't, and the thing is, you can't predict the market. You don't know what the market is going to do. All you do as a trader is react to the information that you see on the chart. So when it comes here, obviously you know uptrend, but you're looking for areas to buy, and you see that price is still going down. You can see this impulsive move down here, then some sort of retracement. But at this point, you can clearly see that price broke the high low. And now, once it's broken the high low, you know, in uptrends, the high lows are respected. But at this point, price broke the high low, which means we had a change of character. So we have a chalk. So change of character, chalk. Okay. And then after the change of character, you'd expect that price would continue going down. Sorry. But what happened was it continued going up. So, I mean, someone can ask, is this change of character valid or not? Yes, it is valid, because when you are in trading, you have to be very systematic and very rigid, because you understand, you just need to be very rigid with your drawing and all of that. However, someone would see this and call a liquidity sweep. So in uptrends, the basic analogy is price should respect the higher highs and the higher lows. Let's go to the book. So in an uptrend, price is supposed to respect higher highs and higher lows. So if you take a trade, or if you take a buy trade, you're expecting that the price will go up. If you take a trade here and you put your stop loss here, so stop loss is an area where you wouldn't want, the broker should automatically close your trade for you when you go in. I'll explain all that later. But when the broker automatically closes the trade for you, that's basically what we call the stop loss. So it's how much you're willing to risk on that trade or how much you're willing to lose on that particular trade. So for an uptrend, it will make sense to put your stop loss at the higher low. Once you've identified the higher low and you take a trade, you can put your stop loss below the higher low, because all through here, you can see price did not come to the higher low. Price respected the higher low. So in the chart, if you want to take a buy, you would not expect that price will come all the way to this high low. Okay, but it means that anybody who is taking a buy, or basically so many traders will be taking buys because they can all see what you're seeing too. They can all see that as an uptrend. So they'll all be taking buys, putting their stop loss here. Before you see, price will just come, take their stop loss, and then what usually happens in the market, a reversal, a massive reversal. So we call something liquidity. So that's just an introduction to the concept of liquidity. Liquidity is just to take out your money or basically hit your stop loss and then continue moving. So I actually explain liquidity. So yes, liquidity moves with market structure. Okay, market structure helps you to know or see the footprints of the markets, the higher highs, the higher lows. If it's an uptrend, if it's a downtrend, the lower highs and the lower lows. Okay, but you can see here is a change of character, all right, but it didn't continue going down. It swerved everybody who even thought it was a change of character and went massively to the upside, continued the trend. So you can even call this a swing low and a swing high, and then a retracement. So all this area can be a retracement if you decide to mark here as your swing low and your swing high. So market structure is individualistic. Right? It's based on how you want to mark structure. Yeah, so I think that's it for this meeting. I think the meeting will end very soon. So I think that's it for, or basically introduction to market structure. I'll send a link so we can have like extra